Hello, welcome back to the continuing lecture in investments. Um, this is Dr. Jeff Holm, and continuing with our topic in risk and return. Um, so we are back to the fundamental question of, how to allocate the assets in our portfolio, how to allocate across, different assets in a portfolio. We saw historical examples in our last video of, how the equity portfolio, world equity has performed over the last 85 years, and how the bond has performed, for the last 85 years, and also in the U.S., small capital, small cap, large cap stocks have been performing for the last 85 years. And you may remember, the reason we are looking at both bond portfolios and, equity portfolios are, of course, quite obvious, because they are complementary instruments, right? Bonds and stocks are complementary instruments. Also, the long-term bond portfolio, even, a short-term bond, treasury bill, treasury note, they are basically the bottom line for rate of returns, right? Bottom line, the baseline rate of returns. In other words, they're risk-free. Treasury bill, right? Treasury bill, treasury notes, treasury bonds, they're risk-free. And obviously, since equity performed way better than bonds, of course, that gives rise to the concept of risk premium, right? So then, when you construct a portfolio, right, you don't. And obviously, if you have $1 million to manage, it would be a foolish idea to put all of that into just stocks, right? Because you are taking, definitely, a lot of risk compared to risk-free assets. As opposed to investing in risk-free assets. So, we always talk about well-diversified portfolio, right? Usually, well-diversified portfolio generally refers to stock portfolio, right? But actually, better than a well-diversified portfolio would also include not only stocks, but also bonds and the risk-free assets, right? All three different, different asset categories, right? Stocks, bonds, and risk-free assets. Therefore, a complete portfolio is an entire portfolio including risky and risk-free assets. Okay, so now a complete portfolio consists of two categories: risky assets and risk-free assets. Okay, so then risky assets would form a risky portfolio, right? if you have risky assets, they are, they group, they are, grouped again as um, uh, if they are grouped as risky assets, then that's a risky portfolio, right? So, um, and then in the risky portfolio, then it breaks down again into stock portfolio, and bond portfolio. Okay, makes sense. The complete portfolio consists of risky portfolio and risk-free assets. Okay, like T-bills and T-notes, risk-free, and then risky portfolio by itself also consists of, stock portfolio and bond portfolio. And of course, bonds corporate bonds are risky, right? Corporate bonds, but treasury, corporate bonds are less risky than stocks, but clearly riskier than the treasury, right? So eventually we will get to how to then, allocating weight, allocating, it's basically, allocating weight. So eventually we'll get to, how to allocate, our funds across, stocks and bonds um, in the upcoming lectures. But for now, we will just, consider, we'll just, think about, allocating allocation of funds between risky portfolio and risk-free assets, right? So the allocation of weight uh, uh, there are two steps, in terms of allocating the weight. First, allocation of, uh, weights or funds, distributing weight or allocating weight, which way um, should I say, but, allocating weight between, risky portfolio and risk-free assets. And then within the risky portfolio, how do we allocate weight between stocks and stock portfolio and bond portfolio, right? And even again within the stock portfolio, then you can have, if you have 20 stocks in your stock portfolio, how do you, then there will be a question of, how much, weight for, each of them. And also in the bond portfolio, if you have 10 bonds, how to, right? Get the idea. So that's called, basically, you're allocating the capital. In other words, your fund, $1 million fund, right? And the risk-free assets, we already know. Treasury is, risk-free. The only risk to treasury is the inflation. But uh, it's systemic. It's a systemic macroeconomic systemic, risk. Nobody's free from it. If you want to protect against, inflation, of course, there's, tips, right? And then money market instruments are effectively risk-free. Money market instruments are short-term, right? Short-term, short-term bonds, government or corporate. Either way, money market risk-free. And the risk of CDs, certificate of deposit and commercial paper, short-term corporate bonds, risk of these instruments is minuscule compared to most assets. So you can construct a portfolio of risk-free assets with these instruments. Again, let's just simplify for our thought experiment. Just let's just call it a treasury, right? And then we will let's call risky portfolio P, right? That stands for portfolio, right? Okay. And risky portfolio composition is predetermined. We are assuming that it is predetermined, right? But we will, as I said, we'll get to the part, in the upcoming lectures, which will be actually next chapter, right? The weight of stocks and the weight of bonds, right? That's what I'm talking about here. Right? The weights, right? Okay. Y is the proportion of investment budget that goes into a risky risky portfolio. Okay. In other words, that goes into risky portfolio, right? So if you're putting 60% into a risky portfolio, then that's Y. And then 1 minus Y, 40% will go into risk-free assets, right? And among these, among this 60%, right? How much weight goes into a stock portfolio and how much goes into the bond portfolio? That's there's going to be another weight distribution, right? From this 70%, right? Now, RF, of course, risk-free rate, RP, is the actual rate of return on a risky portfolio. I mean, this is, calculated from the data, from the past data, right? Of course, Time series is called, time series. Okay. From time series, right? And expected return on the portfolio is, in our example, 15% risk-free return, 7%. And of course, that's, standard deviation. If the standard deviation risky portfolio is 22%, right? And you can tell already, oh, then the Sharpe ratio should, RP minus, RF, right, over standard deviation. You can already get the Sharpe ratio from here, right? Sharpe ratio will be, right, 8% over expected return on the portfolio minus RF. This is not easy. RF over sigma P, sigma sub P, which will be, already. That's going to be 8%, right? 8% over 22%. Okay, and whatever it will be, whatever it will be, 8 times 4, 8 times 3 is 24. So it's less than, like 1/3, right? It's less than. So I can tell already it's going to be 0.3 something. Will be. And expected return on the portfolio, which is, then we can already tell. Expected return on the complete portfolio is the weight that goes into the risky portfolio, right? Weight times R expected RP plus 1 minus weight times RF, right? And then also standard deviation, sigma of complete portfolio is, risky portfolio standard deviation plus 1 minus weight. This is the weight that goes into risky portfolio anyway. Okay, and how do you solve for weight? Question is, how do you solve for weight? We can solve for weight this way. because expected return on the complete portfolio is by definition, right, like this. So it's simply, um, uh, because y is the unknown, right? What we are solving it for y. We'll solve it for y, right? Y is the unknown. So we collect the terms, right, and move, the constant to the right hand side, left hand side, and then look at this. Y equals then, then solving for y is the risk premium on the what is this? Risk premium for complete portfolio, right? Risk premium on complete portfolio, right? Oh, complete portfolio C. I mean, it's basically the. Sometimes I draw a very good straight, line. And when it is totally, least expected, then I do a very good job. I freehand over risk premium Ay, ay, ay. Okay. Oh. So it's basically the ratio of risk premium, ratio of risk premiums, risk premia, one risk premium against another risk premium. Right. The weight is basically, uh, risk premium on complete portfolio, right? I mean, risk premium on complete portfolio would be, I mean, think about it, just logically thinking, logical reasoning. This is logical reasoning. Um, Risk premium on complete portfolio would be smaller than the risk premium on risky portfolio. Why? Because risk premium on the risky uh, assets, risky portfolio would have to be greater because it's riskier, right? Makes sense. Then complete portfolio has kind of more diluted risk because it's got risk-free assets also, you know, um, in it as one component, right? Okay. So now, It's also it can be also I'm going to show you another way of another interpretation of that, but still the same thing. And the bottom part just get cancels out because they are same thing. Let's take a look at this example. Okay, our example here. Suppose investment budget is 300K and borrow 120K. I mean, if you have, and the total, you even borrow, right? But how do you borrow? You might think, go to the bank and borrow. No, actually, if this is um, a corporation or asset management, uh, wealth management firm, you borrow by selling bond, and you borrow by selling bond, right? So, and you put, a whole, 420K in risky asset, then the weight of the weight of the risky asset is 1.4. And the weight in the risk-free asset is negative 0.4, right? And uh, if you can borrow at risk-free rate, right? If you can borrow at risk-free rate, right? So it is like, basically, instead of 70% in risky assets and 30% in uh, risk-free assets, you are actually uh, putting, 140% into the risky assets, and for risk-free assets, negative 40%. So it's like, it's a short position in risk-free assets, actually. It's a short position, right? And then the portfolio rate of return will be completely, 7%. The risk-free return is 7%, and the return on the risky portfolio is 15%. So weight of the risk-free assets times return on the risk-free, weight of the risky assets, and return on risky portfolio, and then you come to, right, 18 point. What did I? 18.2%, right? Now, this is wrong. I mean, this is somehow why, I mean, I cut out and, copied and pasted, whatever was in the book. Without the weight, you cannot come to this without weight, right? You'll have to, of course, multiply by weight, right? Okay. Another way to think about this is that you expect to earn 63K, 15% of 420, right? Okay. And pay, but you'll have to pay interest, right? 7%, right? 8,400, which is 7% of 120K. Then expected profit is, then 54,600, which is, exactly 18.2% of the 300K. Okay, excuse me. But regardless, it will still be the same Sharpe ratio, same, reward to volatility. Whether you suppose you put, 100% into 100% into the risky portfolio, right? What's going to be your uh, risk premium? Risk premium will still be 8%, right? Remember, risk premium will still be 8%, no matter what, right? 100% or uh, uh, and then standard deviation of the portfolio, risky portfolio, right? Will be I mean, even for Sharpe ratio of complete portfolio, right? Let's think about Sharpe ratio of complete portfolio. Even for Sharpe ratio of complete portfolio, right? Uh, Let me. The complete portfolio risk premium on the complete portfolio will still be the risk premium of the uh, what I'm trying to say is, the uh, risk premium on the complete portfolio will be uh, ERC minus RF, right? Okay. So 18.2 minus 7%, it will be 11.2. And that's risk premium. And in determining, what should I write? Standard deviation of the complete portfolio is basically, only the standard deviation of the risky portfolio. Why? Because there's no risk-free assets don't have risk-free asset has no standard deviation, right? Because it's risk-free, right? There's no better way of expressing this. So it is always and only, it is always the same thing, 22%, just by multiplied by weight, right? See, remember Sharpe ratio of the we got to uh, the risk premium on the complete portfolio in this case was 11.2 because of the weight, right? Because there was negative 0.4 into risk-free assets and 1.4 into risky assets, right? This ratio, if you think about it, this ratio, look at this, and 30.8 is exactly 22 times 1.4, right? In other words, it's simply nothing but everything here is simply the Sharpe ratio on risky portfolio times, of course, risk premium. Won't be, it will be, a result of weight times this and weight times this, right? But because the weight that is relevant to the standard deviation in the complete portfolio is totally the risky portfolio's standard deviation, right? This basically the ratio will be the same, right? Whether you 8 divided by 22 or 11.2 over 3.8. This comes to 0.36. And what did I say? I said, oops, what happened here? Why is it? Okay. And you run this number, you calculate it, it will come to exactly 0.36, right? So, the lever portfolio has both higher expected return on the complete portfolio and higher standard deviation than an unlevered position in the risky asset. But however, I would say yet the Sharpe ratio complete portfolio is the same thing as the Sharpe ratio of the risky portfolio. Okay. Now, well, actually, this continues into capital allocation line, but we have already run out of time. We're actually 10 minutes, over time, so I'll have to cut the video here and continue in the next video. Stop recording.